Hey guys, Happy New Year. Hope you had a great holiday break. I'm gonna dive right into SPY and kick off things over here. So as you can see, over the last year, we've had a nice run. From last January, we were at 375 or so on SPY, low of 368. From that point to right now, we've risen, see the exact move we've seen, about 30%. Right, so very, very nice year for anyone that just held the indices. Nothing fancy had to be done really the past year to make a nice profit. And a lot of names were up a lot this year, right? Especially the mega caps. Fortunately, a lot of the smaller cap names, they performed well in the first couple months of the year and they fell back down. So we'll look at a few of them after this. But I want to look at where SPY could head over the next year or so, right? So looking at the option chain for SPY, I'm pulling it up right now. You can see it over here. If we price out the straddle for a year hence, so 1 year from now, we can see that we're expecting a move of about roughly $75 to $80 in one direction, right? The current price. So if we get that move, the upside would be approximately from here, approximately 450 to 455, and the downside would be back down to around 400 approximately, right? So you got to keep these levels in mind as we go over the course of the year, and also factor in that right now implied volatility is low, 12.8%. Historical for the past year was 16% or so. So in planning your portfolio strategy for the coming year, you got to remember that the environment is changing, right? Last year, we had a pretty conservative environment as per flat rates, and the Fed will be raising rates starting in, I believe, March, as well as tapering QE. That will put some constraints on the markets. Companies that will keep doing well should be the FANG names, mega caps, FANG man, right? So Facebook, Amazon, Apple, Netflix, Google, Microsoft, NVIDIA, right? AMD, those names should do very well, right? They're all very large companies. Now, those you could probably hang on to and do decently well over the next year. But there are some names that are very intriguing as well, right? I'll talk about a few of them in a sec. Let's dive into Qs first, right? So triple Q ETF, NASDAQ. Again, a very, very solid year for NASDAQ as well, right? Tech was booming past year. And looking at the expected move for a year out on tech, we can see that we're expecting a move of again, about 75 to $80 in one direction on SPY. So upside would be around, 475 to 480. Downside would be 325 to 320 or so, right? Now, when we get too hot, and by hot, I mean when we run up heavily over the course of a month, for example, usually we have a pullback. We've seen that happen a few times. So, for example, we saw a nice run from the November 10th low of 387. And in a span of about a week and a half, we ran up to 408. So that was a pretty sharp run up. That caused a pullback down to a low of 378 area. And support, keep in mind, is around 380, right? This area right here is support. So you want to watch for this level on any pullbacks in the broad market over the next few months. And keep in mind, earnings are coming up end of January as well. So looking at Qs right here, we do have space to keep running if mega caps keep on pulling us to the upside, right? But keep in mind that the names like Apple, Microsoft, Google, Facebook, Amazon, so on and so forth, are the names that are keeping us to the upside. Without those names, the markets would be flat or possibly even down on the year, right? So you want to be conservative in your allocation as we approach those rate hike events, because they can cause decent market volatility, and you don't want to be caught with your pants down, right, so to speak. So great ways to hedge. The best ways to hedge, in my opinion, and again, if you don't know how these hedges work, do some more research online, or feel free to ask me or someone else from the group. But using put ratio spreads, right? So those are very, very powerful hedge techniques to use. They're the same hedge techniques that professional funds use to hedge their portfolios. and they entail buying one put option and selling two put options against that put option to offset the overall risk. So for example, if we're looking at the QQQ ETF and we want to hedge, a month out or 2 months out, keep in mind, you don't want to go too far up because this requires margin and you don't want to be tying up your margin for a long period of time. But let's say, for example, that you want to hedge out to middle of January, which is 3 weeks away. I don't think this is a great idea because I do think we're going to be very bullish for January, especially given that a lot of names sold off in the latter half of the year. Tax loss selling probably occurred in November and December, and many of those names will be bought back up by people that sold them, right? Because they want to be back in those names again. So looking at the put ratio spread as an example, what you could do is you could, for instance, buy the 390 put out of the money put, and then you could sell two of the, you see the delta here is 0.31. So you'd sell a delta of around 0.16, around the 80 strike here, right? And keep in mind 380 is support. You'd sell two contracts right there. If you notice right here, the aggregate cost of the position is negative roughly 25 cents, meaning that you receive a credit of 25 cents per position, right? And that means that if triple Q were to not fall below 390, you make 25 bucks, right? If we're to fall down to 380, you have upside of $10 per contract. And you have a second break-even price of $10 past this contract, because keep in mind, if we were to fall to 370, for example, what would happen? Your 390 contract would be worth 20 bucks and your 380s would be worth negative $10 each. So you'd be flat at 370, right? So again, support's at 380, which is why I chose this strike. This position is delta neutral. So as long as we're above 390, you're going to lose nothing at all. So basically between 370 and above, you're making a profit on this trade, right? But you do have $10 upside on a move to 380, which is support over the next 3 weeks, right? Again, some conditions you want to have when doing a put ratio spread, you want to have higher implied volatility, because that means that the out of the money contract is trading at a higher value relative to the near the money contract. So you get a lot more credit there, thus reducing your overall cost basis, or even giving you an overall larger credit, right? Secondly, you want to be doing this strategy no more than a month out or so. The reason being is that it ties up a lot of margin in your portfolio, and you can actually test this out if you want and see what the overall margin impact is if you were to do this in your portfolio. But it is pretty substantial, and tying up margin for a period of more than a month on a hedge is not a great idea overall, right? But just some food for thought. If you have any questions about this, feel free to post them in the comments below or ask myself or someone else from the group, and they'll be happy to respond to you, right? So delving into the Russell now, right? The Russell, I think, presents the best opportunity right now because we've seen so many small cap names beat up heavily over the last year or so, right? Or last half year or so. So if I pull up the chart, you can see that we held support pretty well around 210 over the past year. Upside resistance was at around 230, 250, and the high was at 245 roughly, right? So right now we're at 222.87, and I do think we have potential to push back up near the highs of 245-ish, right? So a gain from here to highs would be roughly 10%, right? Not unsubstantial, right? Looking at ways to play that, you could use any number of strategies, but right now, given that implied volatility is normal, it's not too high, it's actually lower than historical, you might want to just be directional with calls, right? If you want to manage your risk a bit more, you can obviously use call spreads to mitigate your overall debit amount, thus your risk. But you're going to want to look at some time on these contracts, perhaps up to February, because keep in mind, buying anything less than a month in time is much more risky, right? The more time you buy on your contracts, and this is just an overall rule for you to use it for trading. If you notice what Nancy Pelosi was doing in her trading, and it's funny that I mentioned this, but she's always buying in the money contracts that expire, 8 to 10 months away to up to a year away, right? That's how you're supposed to trade options for the most part, right? Trading short term is a lot of fun, very exciting. You can generate extreme gains, but also you can lose whatever you put in as well, right? So If you want to generate more consistent gains, albeit not as exciting, you can be more passive by trading in the money options that expire a year out or so, right? I'll go over a few examples in a sec, but back to the Russell, right? So the Russell, keep in mind, we have earnings coming up end of January, so we're gonna see a lot of volatility around that period of time. But playing the upside here, expected move for February OPEX from here is about $14 in one direction. So upside would be roughly 236, downside would be roughly 208, right? And if you wanted to play the upside here on the Russell, you could go out of the money a little bit if you wanted to, and go long a call at, for example, 225, and you could go short a call at, say, for example, 235, right? This caps your gain. Debit costs overall is about 370 or so. So your overall break even would be 228.70 because you add 370 to the strike price of the long contract. And your maximum profit would be 235 less 225 minus your debit amount here. So your maximum profit would be about $6.30, right? So you have almost 200% upside on the trade. And it expires in 47 days, right? So one way to do this alternatively is to leg into it. So for example, you could buy the long call option first, wait for a rise a bit, and then sell an out of the money call option against your long call option, thus reducing your risk further. Like for example, if you ran up, let's say 2%, 3% on Russell in the next couple of weeks, that would take us to around 230-ish, right? If that were to occur, the 235 calls will be going for probably around $3 or $4, meaning that if you were to buy this for around 560 and sell the 235 for about $4, your risk would go from 560 down to about $1.60. Now, the only downside of this is that because you're legging in, you're incurring a lot more risk at the onset of the trade, right? That's the downside of it, obviously. But given that implied volatility is low right now, the risk is muted a fair bit. Although the Vega risk is 0.319. So I don't think we're gonna see much lower than this on the IV. So I don't think there's much risk on Vega. Time decay is 7 cents per day. That's not that bad overall. But again, if you can see the power of using spreads, if you were to use a spread straight away, your time decay goes from 7 cents a day down to about 2.5 cents per day. So roughly about a third. Now, delving into, actually want to look at the overall move expected for Russell before we move on to individual names. So expected move for Russell by end of year, it's about $40 in one direction. So upside 260, downside 180 or so. That's a pretty substantial move. That would be a move of about roughly 18% in one direction. So not too bad at all. But we are pretty beat up on a lot of names, and we'll start going over those right now, right? So I wanted to look at, well, PayPal is not a small cap, but I want to look at PayPal because they are beat up, and they were sold off heavily in the latter half of last year, right? So here's the chart on PayPal. You can see that, let me get rid of these lines. We fell from the all-time highs of 310-ish down to a low of 180, meaning a decline of 42% or so. Right now, as it stands, we're still down about 39%, and we're only about $8.60 off lows, so it hasn't really ran that much. Additionally, because we've been in a tight little range the last month or so, the implied volatility has died down a fair bit. And earnings are going to be occurring in about 30 days or so. So that would represent an opportunity to catch implied volatility expansion into that event, because as we approach that event, people will start buying out of the money calls and puts, causing the IV to increase, which means that if you buy contracts now when IV is low, the IV expansion will occur into the earning event, right? You can actually win before the earning event, take your risk off, and then wait for the binary event to pass, and then get back in if you wanted to after that, for example, right? But one of the things I like about PayPal a lot, given that we've seen massive inflation globally, is that they actually benefit a lot from inflation, right? The reason being is that they take a cut of every transaction that occurs on a merchant's site online. And so if the cost of goods are rising online, that means that their percentage, even though it's the same, higher dollar denomination values at volume would mean that they would get a larger revenue share of that, right? Because they would take an overall larger amount of money off of a larger transaction due to inflation, right? So same percentage, larger dollar value transaction means more revenue in their pocket and obviously more profit in their pocket as well, right? So I do think that PayPal is undervalued, and a longer term approach is a smart way to play it. As we can see, we've been kind of range bound for the last month or so between 180 and like 195-ish. But that could change very fast, right? If we start breaking out to the upside and push toward 216-ish, that would already represent a gain of from the current price of about 14% from here, which is pretty substantial. If you were to catch that gain in, say, for example, the first month of the year before earnings were to occur, that could be a nice gain that could tide you over for most of the year right there in and of itself. So I would play, further out contracts, March or April or beyond if you want to trade it longer term. Again, using the Pelosi method, I'll call it right now. You could buy some in-the-money contracts, for example, as far as 2 years away, and set it and forget it. And instead of buying 100 shares right now, you could buy even one call option. That could be a nice return in your portfolio, right? So let's look at that, for example, right? Right now, 100 shares would cost you about $19,000. But instead of doing that, you could go out to, let's say you go out to January of next year and you buy an in-the-money contract. Let's say, for example, the 150 strike. You're paying $5,200 for the 150 strike. Your break even is 150 plus 52. So your break even is 202, which is only about 1150 above the current price, right? Sorry, 1350 above the current price, right? So not a huge gain required to be at your break even strike price. And if you're doing this in a margin account, you can sell weekly or monthly premium against your contracts above your break even price, right? So that could be one strategy. But again, let's say, for example, PayPal's at $300 again next January. If you bought one contract here versus buying 100 shares, for one, you're spending less than one third of the price of the stock, right? The stock would cost you 19 grand, right? The option would cost you 5,000 and change. And if it were to run, for example, to 250, you make 100% return. 300, you make 200% return. Now, the drawback obviously is if it pulls back down to, let's say, for example, 150 or 100, that 5 grand is gone. But my argument to you would be then that if you bought 100 shares at 190 or 188, and we fell down to 150 or 100, for example, you would have lost more money on that position overall than the cost of the contract you paid, right? So the absolute loss risk is there for options, but you're risking less dollars overall, and you have additional capital on the sidelines with which to use to average down, right? So that's the power of using options in the smart way, in the more informed way, not gambling with them, right? Again, you want to refrain from developing bad habits. Like as we go on to a new year, everyone loves to create, their ideal goals for the year. And I recommend everyone get a notebook and write down your goals for the year, right? And then break them down into sub goals. That's the best way to tackle it, right? And they shouldn't be obscure goals. They should be very specified. So don't say I want to make money this year. I want to get rich. I want to be smarter. I want to get fitter. Develop tangible goals. I want to lose 5 pounds by this date or whatever. I want to grow my portfolio 10% by next year, for example, right? Tangible goals, and then work toward those incrementally. So again, using leaps can be a great way to stress-free trade longer term positions that you believe in. And if you have margin account, again, use permanent covered calls and sell above your break even. And that's a great way to generate income and also lower your cost basis on your position as well, right? So just as an example, again, if you're going long the 150 call for January next year, break even is 202. If I look at, for example, the February strike contracts, February 18 OPEX, right? I can sell anything above 202. So the 210 contracts over here, they're going for 360 or so, 365. If I were to sell those contracts, I'm reducing my cost basis on my overall position for January by 360 or so, right? So I go from a break even of 52 down by 360 down to, 48.40, right? And my break even then goes from 202 or so down to 198.40, right? So not a bad overall way to play it. But let's dive into some other names as well, guys. So looking at, one second. Looking at, so there was SoFi, right? So SoFi, I identified an interesting trade on it for the next year, right? Again, on the same theme of looking at longer term goals. The current price of SoFi is $15.80 per share. Now, an interesting trade. Again, it's a 1 year trade basically, but a neat way to play it would be to buy the stock outright and then sell the 20 strike call options against your shares. Because if you do the math on this, right, you'd be buying at $15.80 or so, right? And you'd be selling these contracts for about $3.70. So subtract $3.70 from your cost basis. So your cost basis is now $12.10. Now, if SoFi rises to $20 by next January, which is very plausible, you're going to make a return of $7.90 over $12.10 risk. So 65% return over the next year, right? And this can be a very passive trade. Again, it's a boring trade. You just set it and forget it. Obviously, you need to understand the company, what they do, why you'd invest in this company, right? Don't take anyone's word for why you should invest or should not invest in a company, right? Do your own research. If you're risking your own capital, you want to be putting your own time in to understand what you're investing in, right? Don't blindly follow someone, myself included, on any strategy or trade you do not understand, right? But in this case, I'm just mentioning as an example of a cool trade that you could take, for a year out. This trade has a potential of a gain of 65% over a 1 year period where you set it and forget it basically, right? So, if you were to buy 100 shares, for example, the cost aggregate would be $1,210 overall, and your upside for the next year would be $790, right? So you can make over the next 12 months, you're making roughly about $66 a month on 100 shares, right? Extrapolate that as you please, obviously, and you can see where it goes. And this isn't just for SoFi; it could be for any number of different equities that you identify that have an interesting asymmetry of risk, right? The reason why I like this is because obviously having the low cost basis by selling the call option, your break even is so low that even if we were to have a bear market over the next year and it pulls back down to $10 a share, you're not that far in the hole, right? You can easily average down, lower your short strike on the call option if you wanted to, if IV were to percolate a little bit. A lot of things you can do to adjust your position overall, right? Speaking of SoFi, expected move for a year out from the current price is actually based on the current premiums, roughly $9 in one direction. So upside would be roughly 25, downside would be roughly like what, $7, $8, right? $7 or so, right? But yeah, they have a bank charter possibly on the horizon, and if they do get that, that should cause a pop in the stock price. I'm long shares myself, and I will keep trading shares, for a while because I do believe that they're undervalued right now, as their acquisition costs for new customers are essentially nil, and they offer what you call a super app, right? So any term is a super app, which is pretty much an app that provides numerous functionality in our day-to-day lives, right? And SoFi provides that in the form of an online banking platform where you can do banking, loans, trading, like investments, all that stuff in one app, right? So just some food for thought. Next up, I want to talk about Crispr, right? So Crispr has gotten beat up very heavily as well, and the reason why I like this industry right now is because not only are they undervalued in my opinion, but I also think that there's room for M&A over the next year, right? We already heard last week, which false rumor of Samsung acquiring Biogen, right? But I think we're going to see a lot of the larger pharma companies start picking up companies like CRISPR, Editas, Fate Therapeutics, Intellia, Beam Therapeutics, because they're so inexpensive relative to their overall potential, right? Like right now, the current market cap of CRISPR is about $6 billion. They have $2.6 billion in cash net, right? And they have a lot of promising solutions, right, for people's health. But right now, as you can see, They've been in pretty much a bear market for the last roughly since August, right? So pretty underperforming stock for the last few months. That doesn't mean that they can't rise back up and push 150, 120 again pretty easily. If you go back to the 2-year chart, you can see that it had a nice run last year from November, it was $85 to a high of 220 in January, right? Very, very fast run. And as I said, at the onset of our session, it's possible that we see a lot of these names that have been beat up heavily run very, very fast to the upside and recover some of their losses, not all of them, but to see a name like Crispr go back to 90 or 100, that would not surprise me whatsoever at all, right? It can happen very, very fast. So you have names like Crispr, Intelia, you have Beam Therapeutics, right? You have Fate Therapeutics, right, over here. And then you have Editas as well. They're all in the same industry, CRISPR or gene editing stocks, right? And they're all pretty heavily beat up right now. So just some food for thought over there. Lastly, there's Palantir, and I had one stock that I've been looking at myself. Interesting setup. So I'll look at Irobot, which is a stock that I identified as possibly undervalued right now. They had a high on a short squeeze of $200 or so, 197.40, and they're currently at $65. Now the cool thing about this company right now is that they're trading at 1x sales right now, right? So they're worth about $1.6 billion, and they're actually doing 1.6 billion right now in revenues, right? So the exact numbers actually are market cap 1.776 billion, revenue is 1.65 billion. So 1.07 times sales, right? Overall, that's very, very cheap for a tech company, even though it's a consumer product company, but their PE ratio is 24.62, and financials are pretty solid as well. So I may take a position here. I'm not sure yet, but I noticed it on the weekend as one of my friends has an Irobot Roomba vacuum and he was playing with it around his house. And I thought, what are they trading at? So I pulled it up on my phone, checked it out, and I was surprised to see that they're trading at, 1x sales right now. So keep an eye on Irobot as a possible play. They have a low float of shares and they have decent short interest as well. So there is potential for short squeezes here as well, though that isn't why I'd be buying it myself if I were to buy it, right? Just an idea right there. And lastly, before we jump into Q&A, guys, there's Palantir. So Palantir, I mentioned numerous times, has come back down to a low of 1821. It's settled in this range between roughly 1750 and like 19 or so the last month or so. And it is pretty beat up. They've issued more and more shares to dilute the stock, unfortunately, but if they do maintain their targets every quarter and they actually hit them or exceed them, their 35% revenue growth, they should see a nice upward to the right chart for the next year or so, and beyond that as well, right? 2 years, 5 years, 10 years out. I do still think they're going to be a very, very large company in the future, and I am very bullish on them as well, right? So over here, I would probably look at Leaps if you're trading, Palantir. Short term, as many of you know, it's burnt a lot of people, right? Because for one, it's been very volatile, and it surprised a lot of people. When we thought it's going to break out, it came right back down again, and we thought it was going to go back down further. It broke out to the upside again, right? So it's been pretty much in a narrow range over the last 9-10 months or so, between 2750 and 1750. It's a pretty tight range. I mean, if you want to trade the range, by all means, but I think longer term, holding a position in it would not be a bad idea, assuming you understand what they do and how they make money, right? I'm going to end it over here so we can get into some Q&A, but if you have any questions at all, feel free to drop them below. Have a very healthy, happy new year as well, and may all of you see lots of prosperity. Any questions at all, just hit me up. I'll be happy to help, okay? Until next week, take care.